We're still expecting the S&P to decline the second half of February. It's been resilient, but technically it's still, on the futures, still in a downtrend since December. Today is February 18. The S&P retested the January 31st high, and we expect to see declining prices into March 3rd through 10th window, and that's the first low area. We're still expecting to see potentially up to 10%, but not a huge crash. This is a corrective move, and it's meant to be in the middle of a sideways pattern that goes on into April or May, and then we shoot up over the summer, make new highs. So we're still expecting higher prices later in the year. This is primarily a video for swing traders. We're not emphasizing the short term, nor at this point are we emphasizing the long term. Several of our prior videos you can review and you'll see the long term picture. The patterns we're looking at are the same usual suspect, the 54-week cycle times 3 and times 6. They've been repeating very well. As a matter of fact, 162-week cycle just topped out yesterday. So that goes down fairly sharply. 49 times 3 week, the 147-week cycle goes down fairly sharply the next few weeks. So we're looking for something meaningful to come over the next few weeks on the downside as a correction that's probably completing some sort of an ABC form that may have started in December, where A was the first leg down in December. The rally in January was the B wave continuing until now, and now we'll see sort of a C wave that could take out the January lows before it's done. And it is also necessary to recognize that the 19 and a third year cycle has been repeating beautifully. It's aligning with our short-term information on the 2-month cycle that repeats, and the 2-month cycle has been repeating very well for a number of months. And this is a picture of what it projects, and so far it's been fairly accurate, as you can see. And it called for this little bounce, by the way, until the 17th through 19th of February, as did the best match that we could find for this particular astrological combination back in 2005, where the market has been extremely highly correlated on an hourly basis for the last 6 months. And going forward, what happened 19 years and 4 months ago is agreeing with what happened the last 2 months, and the future projection of the two aligns delightfully well, where they literally come in with a low approximately the exact same hour. It basically comes out in March 3rd. So that's the beginning of the bottoming area, okay? So it's interesting to see how some long-term cycles are repeating exactly, and some short-term cycles are repeating very well, and that they project the same future. The seasonals are also bearish. The second half of February, historically, on average, over the last 50 years, has been more bearish than bullish. And what we mean is exactly that. If you look at every single year and look at what happened, the predominant direction over 50 years in the past has been the market tends to go down, not up, in the second half of February. And we are right there in the second half of February. And it lines up with our other cycles, so it fits very well. You realize that what we do is basically locate cycles and locate a number of them, and then try to put the pieces together to see how the wave mechanics will add to create the composite wave, which we call the stock market. There are always many cycles moving at the same time, and we have the tools and the technology to locate them using a proprietary formula that we discovered and have been using for many, many years. We have a very, very wonderful course that began 4 or 5 weeks ago, and we're going to start another one based on demand on March 2nd. On Sunday, March 2nd, we're starting another trade forecast mastery class. And if you're interested, click on the link below.